So the property flip. Now, this is one of, in my opinion, one of the best ways to get started in property. And the concept's really simple. You start with the left-hand side of the house and you turn it into the right-hand side of the house. So the idea here is to find a rundown, old, smelly house that's in bad condition, to put some money into renovating the property, bringing it back to market value, and you can make a profit off the difference between what you buy it for versus what you sell it for. So the concept, as I said, buy at a discount. So here's a house, you're buying it at 700. You sell it at a premium price of R1,000,000. The difference between what you bought it at and what you're selling it at is what we call forced appreciation. Now, you force appreciation by adding value to the property. Okay, so now one of the questions that often comes up when we're looking at the flip is, how do I know what to buy the property for? How do I know how to analyze the deal? Okay, so step number one is you have to find a motivated seller. Now, if you look at this picture here on the right, that's a pretty motivated seller, right? It's a really run down, terrible house. It's probably a lot lower, or it's going to go for a lot less than what the market value of that property in that area might be. So finding a motivated seller is very important. Now, you can either find a motivated seller, which means someone who's going through financial difficulties or who's looking to relocate or is essentially motivated to sell quickly, or you can find a motivated property, which is like the one you're seeing on the screen, a run-down property that is in bad condition. Remember, we have to buy at a discount. That's where this strategy works. Buying at a discount is the key. So you have to find motivation. The second key to getting started is finding the right location. Right now, from my experience, the best places to find capital flips are areas that are old, areas that are in middle income areas, and areas that are close to good amenities like the airports, like the cities. You want places that are close, they're suburban, but they are close to the city centers because that attracts your working class people. Now, the reason why we're looking for old is because you need equity in the property. I recommend that you do not go for new builds. And the only reason is because there is no value to add in a new build. It is a clean, squeaky house. There's no way you can add value to it. But if you can go to older areas like, Kempton Park, certain parts of Edenvale that are older, you can find a lot of 3-4 bedroom houses that are outdated. They've got small kitchens and they've got old finishes. They've got the avocado bathrooms. Those are the kind of opportunities where you can go in, freshen it up, open plan the kitchen, fix up the bathrooms, add a lot of value, and sell at a premium price. And finally, as I mentioned, you need equity. You need to make sure that the properties that you're buying are old. They've got bonds that have been already paid off over a period of time. So, explaining equity can be tricky, so I wanted to just create a little chart or a slide for it. Now, imagine that you've got a property that is valued at R1,000,000. That's the value of the property that you have. You've got a loan outstanding or a bond on that property worth 700,000 Rand. That essentially means that you've got 300,000 Rand worth of equity. That's money sitting in the property that, is essentially money you could get out. Now, why is that important? Well, remember, if we want to be going in to buy a property and we need to get a discount, we need to make sure that there is some equity in the deal. Otherwise, even if the seller says yes, the bank's going to say no. For instance, if you've got a property that's valued for R1,000,000 and your loan outstanding is R1,000,000, even if you offer 700,000 on that property and the seller says yes because they're motivated, the bank is going to say no because it doesn't cover their debt. So you need to make sure that there's equity in the deal. The second benefit of finding an equity deal is that 300,000 is money that you can then extract from the bank. You can go back to the bank and say, listen, I've got this property that's worth R1,000,000. I've only got 700,000 Rand debt on it. So the collateral of this asset is still worth another 300,000. I'd like to further advance. I'd like to extract that as capital that I can spend and invest in another deal. So equity is a very, very important part of the property game. So let's say you found this property now. It's run down, smelly, stinky. The big question is, how am I going to work out my offer price? Okay, step number one is you've got to do comparative analysis. Now, what comparative analysis means is, what would you be able to sell the property for if you made it look like this? So you've taken it from this state, you've taken it from rundown, smelly, you've fixed it up to this level. Now, in the current market, what could this property sell for in this condition? This is where we use tools like Lightstone and TPN to do recent sales comparables, so seeing what recently sold in the area and for how much. Let's just say, for example, that based on the reports, this property could sell for 1.5. And this is an example of a Lightstone report. Here you can see the property that I was looking for in Bonero Park, which is in the East Rand. And you can see numbers 5, 1, and 2. Those are properties that are very close to the one that I'm looking at, which is the X. And if you go to the next page on the Lightstone report, you can see that those are the 3 properties that recently sold within that area. So you can take an average of those 3, combine that with maybe consulting with 1 or 2 estate agents, and you could get quite an accurate and quite a confident resale value. So that would be an example. Step number 2, once you've figured out what you can resell it for, you've got to calculate the costs. Now when you're looking at a flip, there are 4 major costs that you've got to look at. Cost number 1 are your buying costs. These are things like your transfer fees, your bond registration fees, maybe your deposit. Any cost associated to buying the property is where you would track that information. The second cost is your refurb cost, or what Nathan calls as rehabilitation costs. Obviously that's the cost to fix the property, to put in the new bathroom, the new kitchen, etc. The third cost is the holding cost, and this is sometimes a cost that people forget about. Now, when you buy a property like the one we're looking at now, you're probably going to renovate that property for 3 months, and you're probably going to wait to sell it for another 3 or 4 months. And during those 7 months that you're essentially just holding this property, waiting for it to sell, you have to pay levies, rates and taxes, insurance, water and electricity, bond repayments, all of your monthly upkeep. And that's what we put into the holding cost. So whatever your monthly cost for holding the property is, times your holding period, gives you what your holding cost will be. And then number 4, your selling cost. Obviously, when you sell a property, the estate agent's going to take their piece of the commission for doing the transaction. So again, I've put some, just some fictitious numbers on here so that we can do a quick example. Let's say that you calculated your costs and it equals up to 300,000. Step number 3 is you have to determine how much profit you want to make, because you need to use your profit as an expense item in your offer price. Now, what do I mean by that? Okay, so the offer will simply be what you can resell it for, so whatever the market value is after you've renovated the property, minus the costs to getting the property to that level, minus your profits, will give you your offer price. So going forward, when you're looking at doing a flip, when you're looking at buying low, selling high, the strategy is always the same. Step 1, comparative analysis. Step 2, calculate the costs. Step 3, determine your profit. Step 4, figure out your offer price, which is step 1 minus step 2 minus step 3. And then the final step that I would recommend you take is then to do some analysis of the numbers, right? So this is where My Property app comes in handy, because it does all this analysis for you. But essentially you want to be using some of these financial metrics to make an educated decision. So, a profit of 200,000 might seem exciting, might seem very nice, but is it an actual good return on investment? Does it warrant the risk that you're taking on this property investment?
Thank you for watching another video on your step to financial freedom. Now, if you enjoyed this content and you're looking at what your next steps would be, well, firstly, go and look at my property investment coaching package. You can find that on lawrencebull.com/coaching. I've put the URL there. It'll explain what the coaching package entails. Alternatively, please go and get a copy of my book. You can get it at any exclusive books, or you can follow that incredibly long link, which is lawrencebull.com/product/financial-through-property. Finally, go get yourself registered with mypropertyapp.online, which is the app that I use every day to analyze deals. It basically is a set of inputs that you put in, and then it'll calculate your return on investment, your exit strategy, your 20-year cash flow projections, your return on equity, everything that you need to know. Until next time, happy investing.